For this session, we will talk about your conceptual framework, particularly your conceptual framework for financial reporting version 2018. So as we start our discussion for this subject, we start first with your conceptual framework, and then we will go on and discuss your different standards. So let's start with your conceptual framework for financial reporting. So before we discuss your conceptual framework per se, we discuss what is financial reporting. So financial reporting involves the provision of financial information about an entity that is useful in making economic decision. So I know that you have already learned this one in your AE 100, the definition of a financial reporting. So what are important things that you need to take note in this particular definition? First is the provision of financial information, and next, the use of that financial information. So generally, the rule is that this financial information is used to make your decisions. Financial information is used to make your decisions. And this financial information is embodied by your financial statements. So when we talk about your financial information, we talk about your economic resources, your claims to these resources, and your changes in these resources. When we talk about your economic resources, we talk about your assets, your claims to these resources, we talk about your liabilities and your equity. When we talk about your changes in these resources, we talk about your changes as your assets, liabilities, and equity. So again, financial reporting is the provision of financial information. When we say financial information, those are items provided by your financial statements. And those items provided by your financial statements are your economic resources, claims to these economic resources, and your changes in these resources. When we say economic resources, these are your assets, claims to these resources, these are your liabilities and equity, changes in these resources, these are your assets, liabilities, and equity changes. Now, we also have here as part of your definition is you're useful in making economic decisions. Based on these resources, claims on these resources, and changes in these economic resources, we try to make decisions. So later on, we will learn what are the decisions that is made by your users. So what decisions are made by your users are learned later on as we go through with our discussion. So again, what is important here is based on your financial reporting, based on that info provided by your financial reporting, we will make decisions. Okay. So what is the primary objective? The primary objective is derived based on the definition of a financial reporting. So since financial reporting is defined as the involvement of the provision of financial information, the primary objective therefore is to provide information that is useful for making decision. And when we talk about making decision, this decisions covers as such investment and credit decisions. When we say investment and credit decisions, we look into the prospects of future net cash inflows to the entity. So we look whether based on the cash inflows, based on this financial information, we try to assess the uh, future net cash inflows of the entity, whether the entity is still profitable or not, or during the next year or the coming years, whether the entity will still continue to operate or not. So these are different decisions. So investment decisions as to your equity portion and credit decisions as to your liability portion. I know by now you already learned your basic accounting equation. Asset is equal to equity. So asset is the equity of your creditors and the equity of your owners or investors. So this particular asset or economic resources came from your equity, that is your claims to these resources. So creditors and owners or investors. So these main users of financial information provided by your financial reporting, which is your creditor and owners or investors, will make decision as to whether they will provide credit or will provide additional investment. So either they will provide or will not provide, or will they invest or they will get their investment out of the company or firm. Okay, so based again on your financial information, what do we do? The provided financial information, we make decisions. Who will make decisions? Primarily, they are your primary users. Who are your primary users again? Your primary users of financial information are creditors and owners or investors. These primary users will now make their decisions as to credit decisions or investment decisions. So again, when we talk about primary objective, it is derived primarily on your definition of financial reporting. If we look into the definition again, it is the provision of financial information for economic decision. Okay. If we look into your primary objective, it is the provision of information to make decisions. Kaso, dito sa primary objective, if we try to look at it, there is now we try to broaden what is financial information and what is the economic decision made by the users. Okay, so for the last phrase into your primary objective, helpful in assessing the amounts and timing of future cash flows. I told you a while back, in making decisions, what does your user do? The user will try to look into the prospects of future net cash inflows of the entity. So when we talk about future net cash inflows or cash inflows, we look as to the amount and timing or extent of that cash flows. Okay, we go now to your secondary objective. The secondary objective of financial reporting is to provide information useful in assessing management stewardship. So another objective, management stewardship. So when we talk about management stewardship, we talk about the efficiency and effectiveness of your management in using your economic resources to provide profit or to provide cash flows to the entity. So efficiency and effectiveness of management. Okay? So primary objective, provide information useful for decision making. Secondary objective, that is management stewardship. Okay. So that is your financial reporting. So financial reporting, provision of financial information in making economic decisions. We go now to your standard setting. So what is the standard setting in the Philippines? So the standard setting in the Philippines is headed by your FRSC. So if you try to remember, we have your Board of Accountancy, we have your Board of Accountancy, that is the official body or the official board to administer or regulate the practice of accountancy in the Philippines based on the Philippine Accountancy Act of 2004, that is your RA 9298. So upon recommendation of the Board of Accountancy, with the function of establishment and approval of accounting standards, establishment and approval of accounting standards, we have now your FRSC. Okay, so if you try to look at it, first there is a governing law, RA 9298, which now created your BOA. Now your BOA recommended for the uh, establishment and approval of accounting standards. And for this establishment and approval of accounting standard, it needs a committee. And what is that committee or council created? It is known as your FRSC. So FRSC stands for Financial Reporting and Standards Council. Okay? Financial Reporting and Standards Council. So again, from RA 9298, which is the law that governs the practice of accountancy here in the Philippines, created the Board of Accountancy. Now, the Board of Accountancy created the Financial Reporting and Standards Council, which is now tasked for the establishment and approval of accounting standards here in the Philippines. Now, your FRSC is composed of 14 members and a chair. Take note, 14 members and a chair, which equates to total 15 members. And this 15 members is composed of one chairman and 14 members. Okay, so 14 members and a chair, or 15 members in total. Okay, so this 15 members is composed of the following. We have your BOA, COA, SEC, BIR, BSP. We have also your FINEX, your Financial Executive Task for Preparation. We have also your sectoral representatives. So one from BOA, one from COA, one from SEC, one from BIR, one from BSP, one from Financial Executive or your preparers, and 2, 4, 6. We have 8. 8 sectoral representatives. Okay? Plus 1 chairman. Okay, so one chairman, BOA, COA, SEC, BIR, BSP, financial executive or your preparers, and sectoral representatives, which is composed of 8. So take note of the 14 members. When we talk about the 14 members, it is your BOA, COA, SEC, BIR, BSP, FINEX, and your sectoral representatives. When we talk about your sectoral representative, if you still remember the 4 areas of practice of accountancy here in the Philippines, we have your public practice. This is more of audit. We have your commerce and industry. This is your private practice. We have also your academe, which is for your education and those engaged in government. So government practice. So each is provided 2 slots for your FRSC. Okay, so what is the main task of your FRSC? That is to establish and approve accounting standards. Now, this will be headed by a chair and composed of 14 members. So please take note of the 14 members and the chairman. Okay, so that is your FRSC. So in the Philippines, what is the standard setting body? The standard setting body in the Philippines is known as your FRSC. How about the standard setting body that is composed by your international body? The standard setting body internationally is known as your IASB. IASB means International Accounting Standards Board. Okay. So we have your International Accounting Standard Board. It is a standard setting body that issues your accounting standards. The board is established as part of your International Accounting Standards Committee. So IASC, this is the committee really tasked to account really tasked for accounting standards, and under it we have your International Accounting Standards Board. Now, your International Accounting Standards Board, again, will issue your different standards. And these standards are composed of the following. We have your IFRS, IES, and your interpretations. IFRS stands for International Financial Reporting Standards. IAS stands for International Accounting Standards. And interpretations comes from your IFRIC. So we have your International Financial Reporting Interpretations Committee. So this is Interpretations Committee. Okay. So again, Your standards under your IASB is composed of IFRS, IAS, and your interpretations. So together, they are known as standards. The three, they are known as accounting standards. Okay, this accounting standards is collectively known as IFRS. So when we talk about IFRSs, it means the three. It's either IFRS, IAS, or interpretation. Now, in Philippine setting, the Philippines adopted the standards of IASB. So in Philippines, we know this as PFRS, Philippine Financial Reporting Standard for IFRS. So the counterpart of IFRS is PFRS. You also have your IAS or International Accounting Standards. The counterpart here in the Philippines is known as Philippine Accounting Standards. Lastly, you have your interpretations. The counterpart here in the Philippines is known as your Philippine Financial Reporting Interpretations Committee or your PFRIC. So these different standards are also known collectively here in the Philippines as PFRSs. Now, maybe you are asking, or a question might pop out on your mind whether these standards are the same. The IFRS is it the same with PFRS? The IAS is it the same with PS? And the interpretations is it the same with PFRIC? Actually, yes. Whatever is the standard provided by IASB, we just copy it. Actually, we do not really establish standards. We do not really make our own standards. We just copy the standard provided by the international body. We just change it into Philippine settings. So actually, we just change international to Philippines. Anything that has international with it in the standard, we change it with the Philippines. So actually, we do not make our own standards. What we do, we just adopt. We just adopt standards or we just copy standards coming from our International Accounting Standards Board. Sir, is there a problem as to the adoption of the accounting standards and not making our own accounting standards here in the Philippines? Actually, there is no problem with it because the accounting standards provided by the international body is composed of different formers of accounting standards coming from different countries across the globe. Hence, the accounting standards now is provided by the input of your different countries also. So what we do here now with your IFRS is that it now make an equal opportunity for each country to adopt the same standard. Now, having the same standard, the application of accounting across the globe will now be better and more efficient and effective. Why? Because we will only apply the same standard among all countries, in the exception of United States. United States is still under US GAAP and they do not adhere to the IFRS. So if ever you try to go to Hong Kong, you try to go to India, you try to go to New Zealand, you try to go to Australia, you will still apply the same accounting standard, and that is your IFRS. It's just that the name changed. The name was changed, and they try to make it based on their own standards. So for us, from IFRS, IAS, and interpretations, we change it to PFRS, PAS, and PFRIC. But although they have the same content as what is provided under your IFRS, IAS, and interpretations. Okay? So again, what is the function of FRSC? They establish and approve accounting standards. But actually, what they do is they just adopt accounting standards provided by your IASB. Okay. Another question that might be on your mind right now is there a hierarchy of accounting standards? Does it mean that IFRS is higher than IAS or IAS is higher than interpretations or IFRS. So now we are talking as to the status of these standards, whether one standard is higher than the other. Now, to answer your question, the answer is no. The accounting standards, IFRS, IAS, and interpretations has equal authority. Okay? They have equal authority. So no one is above the other. We cannot say that IFRS is above the other, IAS is above the other, and interpretations is above the other. Actually, they have equal authority, so they apply equally among all your different transactions and events. Now, for IFRS and IAS, if you can see it, or if you try to base it, if you try to research already, your IAS and IFRS are numerically provided. So if ever they are published, they are provided based on numbers. So we have IAS 1, we have your presentation of financial statements. IAS 2, we have your inventories, etc. But if you try to look at it, some numbers were already removed. So if we try to look at these standards, mapapansin nyo na magkakasunod siya numerically. So it was categorized numerically. However, some standards or some numbers are already missing. So for example, IAS 3, IAS 4, IAS 5. So those are already removed. So if you try to look at it, bakit kaya natanggal na siya? So if ever you try to research on your standards soon and you will see some missing numbers on the standards, it means that those missing numbers are already superseded. So the missing numbers on your standards are already superseded. What do we mean by superseded? It was already changed by another standard, changed by another accounting standard. Actually, IAS or International Accounting Standard is the old accounting standard that we use. Right now, we are in the process of changing it into PFRS. So some items of IAS was already changed into PFRS. So some are already superseded or changed by PFRS. But still, there are still accounting standards coming from IAS that is still used up to this date. But in case you are wondering why some numbers are not present, that is because they are already superseded due to the fact that we are now inclined to move to PFRS. Because some accounting measurements and recognitions under IAS is not already applicable as to this date. So we need to change our standards from time to time. Okay. So again, FRSC is the accounting standards setting body here in the Philippines, but we adopt our accounting standards from IASB. When we talk about accounting standards, we mean IFRSS or PFRSS. They are collectively known as IFRSS or PFRSS. And they are composed of three accounting standards. And what are those three accounting standards? You have your PFRS, PS, and PFRIC or IFRIC. And when we talk about their status or as to their hierarchy, they have equal authority. Okay? They have equal authority. Now, perhaps your question is, how about a conceptual framework? What is the status of a conceptual framework? So when we talk about your standards, we talk about the three PFRSS. Okay, we talk about the PFRSS. So where is conceptual framework into that accounting standards? So by now, maybe uh, you have as of now that perhaps conceptual framework is different from accounting standards, and you are correct. So in this particular subject, conceptual framework is different from accounting standards. So when we talk about accounting standards, it is exclusive on the three items. That is your PFRSS. Conceptual framework is a different species out of your accounting standards. So we will discuss conceptual framework separately and we will discuss accounting standards separately. But now, what is a conceptual framework? So conceptual framework sets out the concepts that underlies the preparation and presentation of financial statements for external user. So actually, conceptual framework provides for the guidelines in the creation of your accounting standards. So it provides concepts and different different topics as to help the formers of your accounting standard guidelines in creation of the accounting standards. So it provides all the necessary concepts for you to create accounting standards. And take note, I told you that when we talk about accounting standards, we dwell about your measurement, recognition, preparation, and presentation. So your accounting standards is guided by your conceptual framework. Your accounting standards is guided by your conceptual framework. Now, what then is the status of your accounting standards versus conceptual framework? We said that your accounting standards now govern for your financial reporting. So what you use on your financial reporting is the accounting standard composed of PFRSS. Now the question is, what now is the status of the conceptual framework as regard your accounting standard? So take note, a conceptual framework is not considered a standard. So what then is the use? Only to set out concepts or guidelines for your preparation and presentation of your financial statements. Actually, under your accounting standard, that is PAS 8, so accounting policy, changes in accounting estimates and errors. So this is known as your accounting policy, changes in accounting estimates and errors. So under PAS 8, it provides you the hierarchy or the use of both your standards. So under your hierarchy or PAS 8 in using your accounting policy, what do we use? So what is an accounting policy, by the way? It sets out your recognition, measurement, presentation, and disclosure of your different line items. So based on that accounting policy, what will we apply? Of course, the first one, we say that is your PFRSS. Kasi nga sabi natin, what we use on your financial reporting is your accounting standard. And your accounting standard is known collectively as PFRSS. Now, what if there is no accounting standard to apply on that particular transaction or event? Okay, so what do we use? So for example, guys, we have here a property, plant, and equipment. We have here a property, plant, and equipment. This is the transaction or event. So based on your transaction or event, we apply the particular accounting standard. So, based on your PFRSS. Kasi nga, sabi natin, guys, you should have an accounting policy for your recognition, measurement, presentation, and your disclosure. And this is based on your PFRSS. So if this transaction or event, for its recognition, for its measurement, for its presentation, and for its disclosure, we need to take a look for an accounting standard that applies to it. So our example, our transaction or event applies to a property, plant, and equipment. So we purchase a property, plant, and equipment. Question now is, what is the applicable accounting policy that we must use? That is your PFRS. So in PPE or property, plant, and equipment, do we have a specific standard that applies to it? Yes, that is your PAS 16. So since there is a specific accounting standard that applies to it, we use it. So we can apply that. Question is, what if there is no accounting standard? What if there is no accounting standard that surrounds it? So for example, we have here your cryptocurrencies. So cryptocurrencies has a wide application as of this date. So do we have any other, or do we have a specific accounting standard that applies to it? So the question now is there a specific accounting standard that is to be applied on cryptocurrencies? The answer is there is no specific standard. Okay? There is no specific standard. Since there is no specific standard, what do we use? Okay. If there is no specific standard, there is an absent of standard, you must use judgment. Okay. In using your judgment, you must refer to the following. First, on your other PFRSS. Sir, what do we mean by other PFRSS? When we talk about your PFRS per se, we'll need to look at the title itself, whether it is embedded on that title. So we have here property, plant, and equipment. And past 16 is known as property, plant, and equipment. Okay. For example, we have inventory. Do we have a specific standard on it? Yes, we have your past two, known as your inventories. Now, our main problem is cryptocurrencies. Is cryptocurrency provided by a standard? Specifically, none. Therefore, we go to the next hierarchy, that is the use of judgment. So in using your judgment, the standard or past 8 provides that you must refer to other PFRSS. So what does your other PFRSS mean? Though although it is not provided on the title of the standard, inside the standard, you can make use of that to measure or to recognize a particular item. So our main problem now is cryptocurrency. So cryptocurrency, is there a standard that can apply to cryptocurrency? Yes, there is a standard. If you use it only as an investment per se, then you can use PFRS 9, that is your financial instrument. If you use it as uh, as part of your buy and sell trading, you can still use it as part of your investment or financial instrument. But if you just sell it, you can make use of inventories under past 2. Some say you can still account it as property, plant, and equipment if it is for long-term use. Okay. So those are the items that perhaps you can apply into a cryptocurrency. Okay. So again, in our example, we have here PFRSS is specifically applying to a particular transaction or event. So PPE, past 16, because past 16 covers property, plant, and equipment. Inventory, past 2, because past 2 applies for inventories. Now, in cryptocurrencies, there is no specific standard that applies to cryptocurrencies. Therefore, what do? We refer to other PFRSS. So when we talk about other PFRSS, that perhaps inside the PFRS, we can apply it to that particular transaction or an event. So if we look or try to look into your different standards, do we have standard that can apply to cryptocurrencies? Yes, we have. We have PFRS 9, that is your financial instrument. Sir, what if there is no other PFRS? So you already exhausted your PFRSs, the list, wala doon. Tinignan mo yung loob pa ng PFRS, wala pa rin nag-a-apply. Ano nang gagamitin mo? You must now refer to the conceptual framework. You must refer now to conceptual framework. Kaya nga sabi dito guys, that when developing an accounting policy in the absence of a standard or an interpretation, you can require or you can refer and consider the applicability of the conceptual framework. So ayan yung ibig sabihin niya. So under past 8, nagbigay siya ng hierarchy. Tama? So ang sabi doon, if ever there is a transaction or event, you apply the accounting standard. And what is the accounting standard? It is known also as your accounting policy. That is your policy of recognition, measurement, presentation, and disclosure. What do we use? PFRS. If not, we use your judgment. In using your judgment, what do we apply again? Your other PFRSs. But after exhausting all of your accounting standard, or your interpretations, there's still nothing that can apply to that particular transaction or event. What do we use now? Your conceptual framework. So what is the use actually of conceptual framework? It is only in a supporting role. What we really apply is your accounting standards. Okay. So when do we use your conceptual framework? Only if there is no standard that applies. You use or refer and consider your conceptual framework. So in using your judgment, refer to conceptual framework. Sir, what if there is no standard? We cannot make use of other PFRS. We cannot still make use of the conceptual framework. What do we do now? So you try now to use the following. First, you can use the other standards from standard setting bodies. Okay. You can now use the other standards from standard setting bodies, and you can make use of your literatures. Okay. So what is this other standards from other standard setting bodies? Okay, we know that our standard setting body is FRSC, and we adapted it to IASB. So what other standard setting bodies can we make use? We can use of US GAAP, or US Generally Accepted Accounting Principle, because US GAAP is a standard setting body also. Or if ever, using the standard setting body, wala pa din, you can make use of your other literature. So you can use of the opinions of authors, you can use of textbooks, magazines, journals to account for that particular transaction or event. Okay, let's wrap up this status of your conceptual framework. We said that it only sets out concepts that underlies the preparation and presentation of financial statements. It really provides guidelines. Now, what then is the status of your conceptual framework? The first rule that we learned here is that conceptual framework is not considered as an accounting standard. And we also learned that your accounting standard is your accounting policy. And this accounting standard is known as your PFRSS. Now, what is the hierarchy then, or what is the use of your conceptual framework? Under PAS 8, it provides you of the hierarchy in the application of an accounting policy. So what is the hierarchy? First, we apply if there is a specific accounting standard or PFRSS. If there is no PFRSS, we use our judgment. In using our judgment, you must refer first to other PFRSS. So when we talk about other PFRSS, that perhaps although in the line item or in the title it is not covered, but inside that particular standard, it can be covered. If there is no other PFRSS, we use now conceptual framework. That's why we say that your conceptual framework is only in a supporting role, because what we do really is first apply the accounting standard, and then if there is no accounting standard, we refer to your conceptual framework. Take note, we only refer to your conceptual framework. Required to refer to your conceptual framework. Now, what if there is no conceptual framework? That even if there is already a transaction or event, you try to use the conceptual framework, you cannot still account for it. What do we use? You use your we use the other standards from standard setting bodies. So other standards from standard setting bodies such as your US GAAP. If still after exhausting your US GAAP, wala pa din, you can now make use of your literatures such as the opinions of your authors in a textbook, those journals, those magazines, those research papers you can make use to account for a particular transaction or event. Okay? So again, our rule, if there is a transaction or event, you use your accounting policy under your PFRSS. If not, then you can use your other PFRSS and then conceptual framework. I hope we are clear already and we already set out the difference or the limits of a conceptual framework and the limits of your accounting standard. So we apply accounting standard And if there's no accounting standard, we can refer to conceptual framework. We go now and talk about the different parts of our conceptual framework. So our conceptual framework is composed of different chapters. So we start first with chapter 1. So the chapter 1 of our conceptual framework is known as the objective of financial reporting. So when we talk about your objective of financial reporting, we talk about your purpose of financial reporting. So a while back when we started our discussion, we already discussed what is financial reporting. Financial reporting is the provision of financial information that is useful for economic decision making. Now, when we talk about your purpose, your financial reporting has two purposes. The first, you have your primary purpose, that is to provide financial information useful for decision making. The second purpose is to provide for information regarding the stewardship of management. So, under the conceptual framework, was this objective differ as to the objective we provided initially? No. Under the conceptual framework, the objective of financial reporting remains the same, and that is to provide financial information that is useful to users in making decisions. Now, again, we have here two items that we need to look at. The financial information, and this financial information is used to make decisions. Okay. So again, what are the financial information that we need to look at? So we said your financial reporting provides for financial information. And what are those financial information? Those financial information are your economic resources, your claims against those economic resources, and your changes in those economic resources. We already expounded what is an economic resource, the claims on this economic resource, and your change in those economic resource. So when we say economic resource again, that is an asset. When we talk about your claims on your economic resource, this can either be a liability or equity, and we have your change in your economic resource. Another information that is provided by your financial reporting is the efficiency and effectiveness of management. Okay, so we look whether the management is efficient and effective as to the discharge of its duties in the use of this economic resource, whether the management make use well or make well use of your economic resources so that the company operates effectively and efficiently. Okay. Now, based on this financial information, what are the decisions that is made by your users? So, when we talk about your users, again, we said these are your primary users. Who are your primary users again? We said these are your creditors, and these are also your investors or your owners. So, what are the decisions of these users? The first decision that your users take a look into is whether they will buy, sell, or hold investments. Buy, sell, or hold investments. So, these are your investors or owners. They will try to look whether, based on this economic resource, the efficiency and effectiveness of management, they will try to look whether they will buy, sell, or hold investments. Another decision that your users will do is to provide or settle credits or loans. So whether the creditors will provide or settle credits or loans. When we say provide more. When we say settle, they will now try to collect the credits or loans. Another is to vote or manage the management actions. Right? Vote or manage or influence the management actions. So these are done again by your investors or owners. So normally buy, sell, hold investments are made by your investors or owners. Provide, settle, or credit loans are made by your creditors, and your vote or manage management actions or influence management actions are also done by your investors or owners. But normally, to make this decision, it is not enough that we have your economic resource claims on economic resource and your change in your economic resource. This economic resource claims on your economic resource and change in economic resource provides for your future cash flows. And based on your future cash flows, we make these two decisions. And what are the two decisions that can be made out of these future cash flows? The buy, sell, or hold investments, provide or settle credit or loans. So for example, guys, if you can predict that in the future the cash flows will go down, that perhaps based on this cash flow, the company will go bankrupt, then what should you do? As the owner, you should sell your investment. As the creditor, you should collect or you should settle the credit or the loan. Because based on the economic resource, okay, so based on this financial statement, we have here your future cash flows. And based on your future cash flows, you predicted that the cash flows over the years will go down. That with this, the company has a tendency to become bankrupt. And out of this tendency, as the investor or the creditor or the primary users itself, what should be your decision? Of course, you should sell your investment as the owner and you should collect or settle the loans if you are a creditor. Therefore, out of this financial information, this is the financial information. What do we make use out of that financial information? We try to get the future cash flows. And based on that, what decisions do we make? We buy, sell, or hold investments, or provide, settle credits or loans. Another information, another information that is provided under your financial information is efficiency and effectiveness of management. Out of this efficiency and effectiveness of management, what information is provided? The information provided is the management stewardship. And based on this management stewardship, we can make decision. And what is the decision that can be made? You can vote or manage or influence the management action. So if you think that out of the financial information given to you can see that the resources are not properly managed. What do we do? You try to change the management because again, the full utilization of resources will try to flourish our company. So in case all of your resources are properly managed, so we make use of our assets well, then probably we have a profit. But if we try to look in your financial information, still we had a loss. What's the problem maybe? That can be the efficiency and effectiveness of your management, and that is your management stewardship. And out of that financial information, what can be your decision? You can vote to elect or to remove that particular manager. Okay, so that is for management stewardship. Okay, let's try to wrap up this particular objective of financial reporting. Okay, so for financial reporting, what is the end product? Financial information. When we talk about financial information, this concerns your financial statements. And what does your financial statements provide? It provides the economic resources, claims on economic resources, changes on economic resources. Further, your financial statements or financial information provides also for efficiency and effectiveness of management. When we talk about your economic resources, claims on economic resources, and changes on economic resources, we have here your future cash flows. So out of these future cash flows, guys, we try to make decisions. What are the decisions that can be made? Buy or sell, hold investments, buy your investors or owners, provide or settle credits or loans provided by or made by your creditors. Okay? So out of these economic resources, anong makukuha nating info? Future cash flows. And anong pwede nating decision? Dalawa. Pwedeng gawin yan ni investor or owner or ni creditors. Next, the another information that we can get out of your financial statement is your efficiency and effectiveness of management. So in your efficiency and effectiveness of management, we get your management stewardship. That is what we look into. So the info provided by your efficiency and effectiveness is your management stewardship. And what is the decision that we can make out of that management stewardship? That is to vote or manage or influence the management actions. So we can help our managers to gear towards the prosperity of the company, or if ever we don't like our managers, we can vote them out or we can elect another manager. Or if the manager is working effectively, then we can opt to stay or opt to continue getting that manager. Okay, so here in our objective of financial reporting, we further discuss the information and we further discuss the decisions that are made by your primary users. Again, who are your primary users? Creditors, investors, or owners. And what are their decisions that they can do out of the financial information or they can make? We have your buy, sell, hold investments, provide, settle credits or loans, vote or manage, influence the management actions. What financial information are provided by your financial reporting? We have two: economic resources, claims and changes in economic resources, efficiency and effectiveness of management. What information is use out of this financial information, your future cash flows, and management is stewardship. So please do not forget this concept of financial reporting. Okay, so we're done now with chapter 1 of your uh, conceptual framework. We proceed now on your chapter 2 of your conceptual framework. So under chapter 2 of conceptual framework, we are to discuss now the qualitative characteristics of financial information. So in this qualitative characteristics of financial information, we need to take a look what makes financial information useful. What makes financial information useful? So, financial information is useful if the following items are present. First, we have your fundamental qualitative characteristics. Next, we have your enhancing qualitative characteristics. Okay, so for information to be useful, what is present only, what needs to be present only is the fundamental qualitative characteristics. Okay, so take note, your qualitative characteristics can be divided into two. We have your fundamental and we have your enhancing. Okay, so what is important only so that our financial information is useful? It must be fundamental. And what are the items of fundamental? The items of fundamental are relevance and faithful representation. Okay, so under relevance, Relevance means that it must be capable of making a difference to the decision made by your users. So capable of making a difference. It is capable of making a difference if ever it has a predictive or confirmatory value. Okay, so again, it is relevance if ever it is relevant if ever it is capable of making difference. Okay, so perhaps one item is relevant and another item is not relevant depending on the transaction or event. So based on your transaction or event, we need to take a look if ever it is relevant or not relevant. So when we say relevant, it must be capable of making a difference. So what does this difference mean? You can make different decisions based on that information. So for example, there is an information regarding economic resources. So you can make different decisions out of that economic resources. Will you buy? Will you hold? Or will you sell? When we say buy, you purchase more. When you say hold, you stay at that amount. When you say sell, you will, of course, sell your economic resource. So out of the transaction or event, we must need to look whether that particular transaction or event can make a difference. Now, when can we say that it can make difference? We can say that it can make difference if the following ingredients are present. So what are the ingredients? So first, we have your predictive value, feedback value, also known as confirmatory value, and then lastly, it must be material. So we can say it is relevant if the three items are present: predictive value, feedback value or confirmatory value, and then it must be material. So when we say predictive value, you are capable to predict the items that can happen out of that particular transaction or event. So for example, you have here an investment in stock. Do you know what is an investment in stock? Or do you invest in stock? So you purchase shares of stock of a particular company. So let's say you invest in San Miguel Corporation. You invested in San Miguel Corporation. So that is your transaction or event. So out of that investment, you try to look whether there is a predictive value. So you try to predict, the value of the stock will increase throughout the year. So over the years, you can see that there might be an increase on the value of the stock. That is your prediction. That is your prediction. What is a feedback value or confirmatory value? So let's say this is on January 1, 2021. And then on December 31, 2021, you saw that the value of the stock decreased. Okay, so out of that prediction, you will now give a feedback whether that prediction is true or false. So what is your prediction? That the value of the stock will increase. However, what is the feedback or confirmatory value? That the value of the stock decrease. So it has both ingredients. You can predict at the same time there is a feedback as to that prediction, whether or not the prediction is true or not. Finally, it is material. We say it is material if it can influence the decision making of the user. So one item is material as to one user and another item is immaterial to another user. So it depends on the user itself. So for example, guys, 1 peso can be material to one person and 1 peso can be immaterial to another person. Because guys, materiality is dependent on your own threshold. So for example, we have here San Miguel Corporation. Maybe their materiality is 20,000, 100,000, whatsoever. They think that 20,000 is material to them. But to one entity, 1 peso is material to them. So let's say we compare a sari-sari store and a San Miguel Corporation. So let's say 20,000 pesos. 20,000 pesos for a sari-sari store is already material. Masyado nang mataas para sa kanila pagka gumastos sila or meron silang item na worth 20,000 pesos. So, yun yung threshold nila. Pero sa San Miguel, let's say yung 20,000 mababa pa yon. Kasi nga, it is a billion peso company. So perhaps 100,000 is still immaterial to them. So you see, there is a difference as to the materiality threshold of different corporations or company. Okay, so what again are the ingredients of relevance? We have predictive value, capable of being predicted. So you can predict whatever is the effect of that particular transaction or event. Feedback value can confirm or feedback, have a feedback out of your prediction materiality so long as it can influence your decision making. Okay? So again, that is for relevance. Next, we have your faithful representation. What does faithful representation mean? When we talk about faithful representation, it should be it should mean that your information must be faithfully represented of what it purports to represent. So whatever is information ought to represent, you should represent it. It should be faithfully represented. So presented based on what it purports to represent. Okay. So when can we say that a particular financial information is faithfully represented if the following ingredients are present? So what are the ingredients of your faithful representation? First, it must be free from error. Next, it must be neutral. Next, it must be complete. Okay, so what do we mean by free from error? When we say free from error, it does not mean zero error. When we say free from error, it must not depart from your accounting standards or your PFRSS. Okay, so whatever is your standards telling you on measuring or recognizing that particular item or event, you must apply it. So it must be free from error. Okay? Free from error does not mean zero error. It means that you must not depart on accounting standard or you must adhere to your accounting standards. Next, we have your neutrality. So when we say neutrality, whatever is the effect of that particular this transaction or event, whether it is positive or negative, so whether it will increase the investments or decrease the investments on the company, whatever is the effect, you must always present it. You must be neutral on the presentation of your transaction or events, whether it has positive or negative effect. Okay? Next, it must be complete. All items pertaining to the transaction or event must be completely presented. When we say completely presented, it is already accounted on your financial statements and it is properly disclosed. Okay, so faithful representation has these ingredients: free from error, neutrality, and completeness. So again, we have only two fundamental characteristics: relevance and faithful representation. Take note, guys, that this fundamental representation, fundamental qualitative characteristics is needed so that the information is useful. Okay, I told a while back that this particular conceptual framework is the 2018 conceptual framework. Okay, actually, the fundamental qualitative characteristics are known as your recognition criteria. What do we mean by recognition criteria? When we say recognition criteria, we will recognize the item if these are present. Okay, we will recognize the item if these are present. So what is the recognition under 2018 criteria or 2018 conceptual framework? That is relevance, and faithful representation. Okay? So relevance and faithful representation under 2018. However, under 2010 conceptual framework, these are the different recognition criteria. First, it must meet the definition. Second, it must be probable and measurable. Okay, so here in chapter 2, we learned that the fundamental qualitative characteristics makes the financial information useful, and that is when it is relevant and faithfully represented. However, in your 2010 conceptual framework, when can we say that we can recognize an item? Only if it meets the definition and it is probable and measurable. What do we mean by meet the definition? So for example, you say that an item is a property, plant, and equipment. So that you can say that that item is a property, plant, and equipment, it must meet the definition of a property, plant, and equipment. So it is a non-monetary asset with physical substance. So if that is non-monetary asset and it has a physical substance, then we can say it is a property, plant, and equipment. How about if you say that an asset is an intangible asset? If you say that an asset is an intangible asset, therefore again, you must meet the definition. What is the definition of intangible asset? So under the standard, an intangible asset is a non-monetary asset without physical substance. It is a separately identifiable non-monetary asset without physical substance. So if that definition is met, then we can say it is an intangible asset. So we only compare here the recognition criteria as compared to your previous conceptual framework. So in 2010, the recognition criteria is meet the definition, it must be probable, and it must be measurable. But now under 2018, when can we say that the information is useful, or what is our recognition criteria? First, it must be relevant. Next, it must be faithfully represented. Please do not forget about the ingredients of your fundamental qualitative characteristics. So what are the ingredients again? For relevance, we have predictive value, feedback or confirmatory value, and materiality. For faithful representation, we have these ingredients: free from error, neutrality, and completeness. Okay, we go now to your enhancing. So we're done with fundamental qualitative characteristics. We go now to your enhancing qualitative characteristics. So what are the enhancing qualitative characteristics? So we have here four: verifiability, comparability, understandability, and timeliness. Okay, so what do we mean by verifiability? What do we mean by verifiability? When we say verifiability, it helps us assure that users it helps assure the users that information faithfully represents what it purports to represent. It means that your different users can reach a consensus as to a particular financial information. So for example, you represent that the property, plant, and equipment is a property, plant, or equipment. So if ever different users will convene, they will see on your financial information that it is really a property, plant, and equipment. So normally, what does your verification does? Your verification does help us to depict whether a particular information is faithfully represented. Okay? So ang gagawin, there must be a consensus that what is purported to be presented is properly represented. Kasi nga, kailangan faithful representation siya. So sa verification or verifiability, we need to at least enhance that particular faithful representation criteria. That if ever we can verify it, it means that it is really faithfully represented. Now, under verifiability, we have two types of verifiability. So what are the two types of verifiability? Verifiability can either be a direct verification or an indirect verification. So what is a direct verification? When we say direct verification, you verify the particular representation. So for example, sinabi doon, the property, plant, and equipment is worth 90,000. So you directly verify. Titignan mo yung mga PPE niya. Is it worth 90,000? Tignan mo yung cost, yung resibo, kung 90,000 pa talaga yan. That is direct verification. How about an indirect verification? So you just check the model or formulas or techniques. You try to recalculate the value, whether the PPE is really 90,000 pesos. So in current setup, you look into your market values. Papasok ba na pagka ang printer na to is 90,000 talaga or hindi? So that is indirect verification. So here, what is the information provided? So the information presented is a PPE worth 90,000 pesos. Now, how will you enhance that representation? You can verify it. So how do we verify? Either direct or indirect. So if you want to directly verify it, you go to the company, you look into the receipt if ever the PPE is really 90,000. Now, if you want to indirectly verify it, you can recalculate. You look into the models or formulas. You can go to the particular market, look as to the value. If that particular property, plant, and equipment can be valued at 90,000 pesos. Okay? So again, verifiability. Why is it considered enhancing? It helps to enhance your faithful representation fundamental characteristic. Whether what is really presented is what it purports to represent. Okay, so you try to verify the representation. Next, we have your comparability. Okay, so when we talk about comparability, we look into the similarities and differences among items. Okay, so when we say similarities and differences among items, we try to compare items. We try to compare items. So we compare items from one to another. So for example, guys, in year one, you presented here cash, and then we have here cash equivalents in your financial statement. In year two, you presented cash and cash equivalent. Now, question, can you compare year one and year two? Can you compare year one and year two? Yes, you can compare it. Because again, you have your cash, cash equivalents, and a combination of cash and cash equivalents, right? However, if the question is, can you compare cash to the cash in year two? Not anymore. Because what happened here, in year two, the cash and cash equivalents are merged into one item known as cash and cash equivalent. By that time, you cannot compare it. So what is the important characteristic of comparability so that we can see the similarities and differences among items? One important item under comparability is consistency. When we talk about consistency, you try to make use of the same methods. You try to make use for the same accounting for a particular item. So if you account cash as cash, then cash. If you count cash as cash equivalent, then cash equivalent. But if you account from one item as cash and then suddenly you account it as cash and cash equivalent, there is no consistency on that. So consistency is important in comparability. So what is the goal here? To compare the items. But what helps to achieve that goal? That is consistency. So for us to properly look into the similarities and differences among items, we need consistent accounting. So consistent accounting as to methods and policies among same items. So here, they are same items, however, they are merged into one item in year two. So can you compare? Not anymore due to the merging. So there must be consistency in application. Okay, so when we talk about comparability, there are two types of comparability also. So what are the two types of comparability? So for comparability, you have your intra-comparability and intercomparability. Okay, so when we say intra-comparability, we just compare the financial information within the entity. So pwede you compare the year 1 to year 2, same company because within, inside. Inter, you try to compare the financial information outside the entity. So for example, you try to compare your financial information to your competitors. Okay. So for example, Jollibee will compare its financial information to McDo. Chowking will compare its financial information to Mang Inasal or Jollibee or KFC. Okay? That is intercomparability. We try to compare the financial information outside the entity. If it's within the entity, intracomparability. Okay. So verifiability, again, we try to verify what is faithfully represented. Comparability gives us the right to compare the similarities and differences among items. This can enhance either relevance or faithful representation. So we look as to the consistency of application also. Take note again, comparability is the goal, consistency is the means. We go now to the third item of enhancing, that is your understandability. So when we talk about understandability, it talks about the characterization of your financial information and your presentation of your financial information, that it is properly presented so that you can understand the financial information. So if we present your financial information, if we try to present it, it should be made in a way that users will understand its presentation. That is the concept of understandability. Now, to aid the understandability, normally we have this type of financial statement. And what is that financial statement? Notes to financial statement. So notes to financial statement helps us to understand the items presented inside the financial statement. So normally, in your statement of financial position, statement of financial performance, in your statement of cash flows, you have their different items or numbers only. So to aid us to understand what made those numbers change or what are inside those numbers, we need to look into our notes to financial statements. So it helps us understand more our financial statements. Okay, but take note when we talk about understandability, it is more of your presentation and classification and characterization of your information so that it is clear and understandable. That if the user will try to look into your financial information, it can be understood clearly. Okay, but what aids notes to financial statement? Lastly, timeliness. So when we talk about timeliness, the financial information must be made available to decision makers. Okay, so it is important in making decision if ever your information is timely and relevant. If your financial information is not timely and relevant, you cannot make a sound decision. So, to aid your decision making, your financial information must also be timely so that you can assess and make your decisions on time. What if your financial information the financial information provided to you is 1 year late? Of course, you cannot make a timely decision because that financial information pertains to 1 year before, not as of now. Okay, so for your financial information to be useful, it must also be timely. It must be presented and it must be presented timely as the need to make decision arises. Okay? So again, qualitative characteristics, we have two. What is more important? Fundamental. If there's no fundamental qualitative characteristics, wala yan. Hindi tayo pwedeng mag-account. Pag merong enhancing, sir, pero walang fundamental, bawal yan. Kasi nga, ang importante, fundamental. Sir, paano kung may fundamental, walang enhancing, okay lang. Kasi ang importante naman ay fundamental. Okay? Ang importante naman ay fundamental. Okay? Qualitative characteristics, fundamental and enhancing. Our mnemonics here is Father VCAT. Father VCAT, father, faithful representation. R, relevance. VCAT, verifiability, comparability, understandability, and timeliness. Further, guys, please do not forget about the ingredients or the items inside each particular qualitative characteristic. Okay? So that's it for our class today.